Good evening, everyone. I'm going to go ahead and get started. Today is July 11th of 2023. This is our third quarter economic update for this year. You know, we talked in January, we talked again in April. So this is the one for the third quarter here in July. As a reminder, you know, there is that question box on the little drop-down menu that you have. So if you have a question, please feel free to go ahead and type it in as I go along. And if you can't figure it out and you want to email me a question, certainly more than willing to answer those questions. If I see them while I'm going through, I'll try to answer them. If I can't get to them while I'm going through it, I can respond to your email directly, and we can kind of continue the conversation that way. So let's go ahead and get started. My name, obviously, everybody knows me, Ryan Herbert. That's me previously with the beard. We just had new office photos done, so pretty shortly they'll be revamping our website, adding all the new faces that we've added to our team, kind of updating all of our pictures and everything there. I'm just going to skip right through all this. You know, this is just for informational purposes, not representing any investment advice. Past performance doesn't guarantee any type of future results. Really, this is not a crystal ball, but really just the factors that Mike and myself and our team consider when we're making our investment decisions inside of the portfolios in Charles Schwab. And you know, if you remember what we talked about way back in April, I implemented a lot of those changes to the portfolios back in April to kind of take advantage of what Mike and I thought was going to really happen in the markets. You know, kind of talked about it back then as far as, you know, the timing of when the Federal Reserve's raising interest rates would truly have an effect on the overall markets, when we'll see that. And the timing is normally 12 to 18 months from the start of raising those interest rates. So the thought process was sometime between late June, early August. The market kind of really started to ramp up in May. So I think that we're going to see kind of continued growth in the market over the next couple months and possibly throughout the end of the year, provided the Fed doesn't change their tactics and switch from raising interest rates to lowering interest rates. So, you know, let's go ahead and get started. Obviously want to make sure everybody is aware of all the changes that have happened to retirement plans and IRAs. Started this year, they passed the Secure Act 2.0. They increased the annual catch-up amount inside of 401ks and 403bs, DSPs, up to $10,000. That's for people between the ages of 62 and 64. Now they're allowing your employers, if you're making money, if you're contributing to your Roth 401k, they're allowing the matching contributions that your employer gives you to go into your Roth account versus the traditional account. You know, kind of along the student loan amounts, that allows employers to make contributions to their employees' retirement plans based on how much they're making in their student loan payments, even if they're not contributing to those things themselves. Annuity options inside of retirement plans, that's something that if you're still working and you're still contributing to a retirement plan, whether it's a 401k, 403b, 457, you're going to start seeing the annuity option there. The TSP has been doing it for years. The TSP, that's the government retirement plan. What it looks like for everybody is going to be different, but in the gist of it, it's going to say, you know, based on, you know, you retiring at 62 or 65, here's how much money you could expect this account to generate. That's what they're showing you, that annuity option. But most importantly, they raised the RMD age, the required minimum distribution. This is the amount the government says you have to take out of your 401k once you reach age, used to be 70 and a half, and they raised it to 72. So now this year it's 73. Anybody who reaches age 73 before January 1st, 2030, you have to take your required minimum distribution. And then again in 2033, it's going to go up again from 72 to 75. So you want to make sure that you take that RMD. The government decided to be nice, and they've actually lowered the penalty. The penalty used to be a 50% penalty for any RMD that you didn't take, or if you got the amount wrong, they would penalize you 50% of the amount that didn't come out. They decided that they'd be nice and lower that to 25%. So you want to make sure you take your RMDs out on time, and you want to make sure that they are calculated properly. Most of the institutions will do it for you. You know, if you have annuities, you have IRAs, you get letters from Schwab or North American, a security benefit, or any of the companies that Mike and myself and our team here use. You'll get those letters that say, hey, here's your RMD amount. So it's just important that if you're above age 73, that we're having that conversation before the end of the year to make sure that we've taken out enough to satisfy those RMD requirements. So, you know, let's kind of just dive right into the gist of the conversation tonight. Really kind of talking about what we've seen in the markets, what all the different things that Mike and I look at really mean. So, you know, here we have the leading economic indicators. It's a compilation of all the different economic indicators that are out there. You know, recently it feels like the overall economy, which is what this chart is showing us, and the stock markets are on different tracks. You know, these economic indicators really have been flashing recession signals for you know, the past couple of months. You know, what we see here is that the economic indicators have continually declined for about 13 months here. But yet the S&P 500, the overall markets continue to just move higher. Manufacturing activity is fairly weak, but the services industry is kind of going strong. Just back in June, the Fed said that they are going to pause on raising interest rates for the first time in more than a year, but they made it very clear that they are going to continue raising rate hikes. When we look at the international markets, you know, the Eurozone in particular, they are in a recession. Recessions are 2 consecutive quarters of negative GDP. That is what it is defined as, and that's what they've experienced. Yet, at the same time, they're in a bull market. So, you know, as we get to the second half of the year, there is still a little bit murky, but you know, there are some positive signs that are ahead, but we want to be aware of all the potential risks out there. You know, I know everybody saw a lot of the changes that Mike and I made to the portfolios back in April, and the portfolios really have done nicely. You saw that we made some changes kind of away from so much of the sector rotation style, still kind of using the sector rotation, but kind of going a little bit more international because of the positive upswings that we've seen in the international markets, mostly over in the Eurozone, and then kind of shifting what we've invested here domestically more towards the FANG stocks, Facebook, Apple, Netflix, Google, Microsoft, those stocks there, because that's really what has been driving the market. It's what drove the market after the crash in 2020. You know, so I'm kind of shifting the portfolios over to a much more large cap, well-established, growth-oriented portfolio. So, you know, as we get, we're basically at the halfway point for the year, and there's not much economic clarity. There is, you know, really a pretty strong separation in certain segments of the economy. That's kind of why we made the shifting a little bit out of the sector rotation style. You know, we have weak manufacturing, consumer services remain very strong. The economic indicators, you know, like we're showing here, have increased for the past 13 months. You know, but the stock market continues to move in a positive direction, and as long as the stock market's moving in a positive direction, we are going to remain in the market. You know, the split between the leading data and the coincident data really has kind of become a little bit more apparent since 2020, when a lot of the information, a lot of the economic indicators have been just negative yet the stock market has seen positive returns. So, what we see here in this chart is the economic indicators have contracted for the past 13 consecutive months, only twice since 1961. So only twice in 60 years has these economic indicators gone longer than that. So right here we see 1973, and that indicated that a recession was happening. And then right here, obviously everybody remembers 2008, 2009, and everybody remembers that recession. So it is flashing signs that a recession could be around the corner. But right here in early 2020, late 2020, I should say, we were in a recession as well, because the U.S. had two consecutive quarters of negative GDP. So this is just one of the things that we look at, and I apologize, this is supposed to say contractions, but I obviously spelled that wrong when I was typing this up this morning. Really kind of what we're seeing here, on the surface, these recessionary-like signals that we're seeing from the economic indicators really seem to be at odds with the overall stock market, because the S&P 500, the NASDAQ kind of just continues to go higher. Yet, when we look at the underlying surface really of the markets really kind of reflect a little bit of concern. The Russell 2000, which is the small cap market really that has just become much more linked to a general sense of the economic growth in the U.S., has really started to underperform the NASDAQ, which is large cap tech oriented stocks, for this year. The weekly performance difference of the Russell 2000 minus the NASDAQ 100, we've really seen this separation start to happen here at the end of the year. The Russell 2000 really has only outperformed the market for 10 weeks so far, which is kind of seems a little bit underwhelming when you consider how bad, when our down weeks have happened, you see right here, when our down weeks have happened, how bad those weeks have been. So, overall economically, things don't really appear very rosy when you look at the overall stock market. So there is a very strong disconnect between the economic indicators that we look at and what the overall stock market is doing. As I've said, there's a pretty strong disconnect between the performance of the large cap stocks. Those have really been driving the overall market, and the rest of the stocks on the S&P 500. The majority of the S&P 500 is currently being led by 7 overall stocks. Those are the ones that are positive. Those are the ones that are pulling the market along because they have such large capitalization. And those small caps really haven't been participating as much in the overall growth in the market. I mean, everybody heard the news about NVIDIA when they jumped up that, massive gains this year because of AI. The one positive thing that I can see when I'm looking at overall metrics and I'm comparing the rest of the stock market to those top 7 stocks is that the number of stocks that are now trading above their 200-day moving average, meaning they've risen above the 200-day price point for them, finally has started to turn positive. We're seeing more and more stocks trading above their 200-day moving average, kind of bringing that Russell 2000, those small cap stocks, into positive territory for the year in comparison to those large caps. So I think that if that continues, we continue to see these small cap stocks continue to gain ground on their price. It'll help sustain the overall market growth. But one risk that I would say really is out there is kind of the buildup in bullish investor sentiment. And this chart here is from the American Association of Individual Investors. This is showing that the percentage of people that they survey started feeling more bullish, kind of recently in June jumped to its highest number really since November of 2021. And it's the strongest jump that we saw since November. The percentage gain that we saw is the highest jump we've seen since November of 2020. So it's not really back to the overall peak as far as the overall optimism. But, kind of what we're seeing is that maybe this is pointing to some kind of froth in the market, where, it's called smart money versus dumb money. Smart money is all institutional investors. The dumb money is smaller individual investors that are doing themselves. As soon as we see kind of that uptick in the dumb money going into the market, that's kind of when it tends to seem that maybe we are at a peak, maybe we are overinflated, kind of frothing in the overall market. But, there is optimism. That's kind of the bottom line with this, is that we're finally starting to see, over the last year, we didn't have a lot of people who really felt very positive about the overall market. Now, more and more investors are feeling positive about the market. They're moving money back into the market. I think it is important that we, keep in mind that overall positive sentiment, more and more people getting excited for the market, the dumb money going into the market, if you would, that in and of itself is not really a reason for true concern. It's not really a reason for stocks to all of a sudden reverse the trends that we've seen and start to take a dive. But really what it can be is that if we see some type of something rear its ugly head in the overall market, it really can exacerbate the downturns that we've seen, because so many more people have started pushing their money in and then they panic and pull their money out. So those swings that we can see, the positive and negative, really can become exacerbated by this fact. This is something that I showed last I think I talked about this in January, and I talked about it again in April. The Federal Reserve really kind of continues to follow its normal method. We're going to raise the rates, and we're going to hold, and we're going to wait. Over the past couple months, the Fed made the decision to pause their rates to kind of show that, hey, we're going to think about what's going on in the overall market. The Fed made it very, very clear with this chart. These are the members of the Fed, kind of where they're voting as far as where they think the rate is going to peak out. Right now, I want to say we're at 5.25%. They're suggesting that we're going to see probably another raise, another 25 basis points up to 5.5% before all is said and done, before they finally start to lower rates. We have inflation coming down. Growth in the economy does seem somewhat sluggish in that aspect. I think the fallout from those couple bank failures that we saw in the early part of this year are kind of out of the way. But, the Fed really wants to take a cautious approach. They don't want to go too fast, too quickly, and they don't want to slow it down too quickly in that same aspect. So that's kind of where we are in the short term. We really are looking at hitting our peak sometime this year. And I think that, in the short term, we're going to hit our peak. And in the next year to year and a half is probably when you'll see the Federal Reserve start to lower the overall interest rates. Sometimes towards the end of 2024, early 2025, we'll see those rates start to come down again. And, kind of what we'll be talking about at that point is how do we start that transition back into traditional bond holdings, because now we're in a falling interest rate environment. And just like when we're in a rising interest rate environment, as interest rates go up, bond prices fall. As interest rates go down, bond prices rise back up. So those will be the conversations that we'll start having towards the end of this year, early next year, kind of switching up the overall strategy, because we've been utilizing a lot of that bond replacement strategy in the overall portfolios. One of the things that is a positive in the overall economy is that, inflation pressures truly are easing. The Fed is trying to get back to its goal for the inflation index, which is the personal consumption expenditure, known as core PCE, and that's this yellow line here. They're trying to get everything back down, heading back down towards 2%. This is really the goal for what the Federal Reserve is trying to do. Overall, we saw prices peak in 2022 and they've started to fall back off. It's declined pretty sharply. The core rate in recent months, hasn't made a lot of progress down because you can kind of see it starting to go sideways. But what everybody pays attention to, this headline, which includes food and energy, has started to come down pretty drastically. Wage gains over the same time period are slowing down. Consumer spending really has remained high. Services like airline tickets, oops, sorry, I hit a wrong button here. Airline prices remain high. People are consistently buying those. People are spending a lot of money on travel and vacations and lodging and dining out because people are, kind of tired of everything going on. So, this is kind of really what we're seeing. Wage growth is really kind of slowing down, like I said. Savings rates, the amount of money that people are consistently saving is starting to come down as well. People are spending more of their money. Unemployment is ticking up ever so slightly. It's likely that consumers are going to start being more cautious as they see these things happen. These are all factors that the Federal Reserve takes into consideration when they're talking about what we're doing with interest rates. And I think that'll have an impact on the interest rate in the next couple of months and what the Fed really decides to do. Real interest rates really remain high. The monetary policy, what the Federal Reserve is really doing, as I've been saying, is they're pushing up the cost of borrowing money to a level that really slows economic activity. Slow the economic activity down, manufacturing orders fall, supply builds up, prices come down to get rid of that supply. Real interest rates tend to have the heaviest impact on the overall markets, and that's kind of what we're seeing here. We have our 10-year yield and our five-year yield. The Fed hiked the rates at the fastest pace we've seen in modern times. Real interest rates are now back to the highest rates we've seen since 2009. These rates make it more expensive for people to buy homes, cars, for businesses. It drives up the cost of financing things for investment, financing for hiring and expansion of businesses. And when the cost of finance really becomes too high, it leads to cutbacks. People don't buy as many cars, housing prices start to come down, overall growth slows. I think that the Fed is going to choose to raise interest rates again at the end of this year. If they go too quickly, I think that it really could possibly trigger a recession, but I think that it's kind of built into the market. One thing that people always think about is the yield curve. An inversion of the yield curve has historically always indicated that a recession is coming. And what I mean by that, and it's kind of what you see here, is that the rate for 5 years, for putting your money away for 5 years, pays you more than putting your money away for 10 years. You would think that if I'm going to put my money away for a 10-year period of time, I'm going to gain more interest on my money than if I put it away for 5 years. It's one of those things we're seeing now with CD rates. 3-month CD rates, I was just looking this afternoon, 5.2, 5.3% APR. So, you divide that by 4, that's what you're getting. But you can get 5.3, 5.2, 5.3, even 5.4 on 3-month CDs. And when you put the money away for a year, you're getting 4.9, 4.8. So, it doesn't make as much sense to put the money away for the long time. I think that it's going to be a bumpy ride, to getting to lower interest rates. Really, we want to make sure that we have, still remain concerned about inflation. We have those Treasury inflation protected securities inside of the portfolios, which do offer fairly positive yields, but most importantly, try to provide a buffer against future inflation. Europe, as I said, has officially entered a recession right here. We have 2 consecutive quarters of GDP. This was quarter 4 of 2022, quarter 1, 2023. They haven't released their GDP numbers for second quarter. The overall, the Eurozone economy shrank. Well, I think this is negative 0.1% for the first quarter after a negative 0.1 decline in the fourth quarter. So very, very small contractions in GDP, but the first back-to-back decline since the pandemic of 2020. It is kind of the mildest recession that they've ever seen. You know, going back to 2008, these are pretty drastic drops in GDP, whereas this is just kind of very minimalistic. But, you know, typically when we see a recession, all areas of the economy, like manufacturing, services industries, retail, construction, trading, all tend to turn down around the same time. Yet over pretty much the past year, only the manufacturing and trade have really kind of seen the effects of this recession. But that is also a little bit to be expected by raising the cost of money to purchase items. You know, indicators such as the industrial production overall, worldwide trade volumes, job growth in industry, all really are all indicators that they're in a recession. It can ironically be called a cardboard box recession because any items that are manufactured and shipped and traded tend to go in a box. So the demand for fiber for cardboard, the material that they use to make cardboard, is at recession levels per the industry that apparently watches the level of cardboard box. But the global service industry have continued to grow. Consumers have turned, they are now shopping for experiences instead of goods. The airline industries, transport associations basically doubled their estimate for profit in 2023 based upon the surge in people traveling to North America and Europe. So people are out there spending more money on hotels, spending more money on restaurants, dining out, experiences, travel, those things. People are out there spending money, which are all positive signs for the market because they're injecting this cash back into the overall market. I talked a little bit about the bull market that we've seen in the international markets kind of compared to the overall markets. We have these recessionary signals in the international markets, particularly the Eurozone, yet we're in a bull market in the Eurozone. Part of the switch that you saw happen in the overall portfolios is a shift out of some of the domestic positions that we would normally own over into the international markets. And that really has been to kind of take advantage of this run up right here that we saw in the overall market. This is the MSCI EAFE index. Talks about Europe, Japan, United Kingdom. They're all up well over 20% since the end of October. Really that is the definition of a bull market. Yet comparatively, since October of 2022, the S&P 500 itself is only up 4%. And that really is reflective of the fact that we are just now seeing those small cap stocks turn positive for the year compared to the overall number of those large cap stocks we drive in the market. In general, the greater number of stocks that are positive have been higher in the international markets than the U.S. markets. We're going to see the U.S. markets kind of continue upward. That's really kind of my overall thought process. But I do think that the average international markets do kind of continue to outpace the overall U.S. market, which is kind of offering us a little bit more diversification internationally for the time being, until we start to see a greater shift in those small cap stocks beating their 200-day moving average and turning positive in the overall markets. And that is pretty much what I have for everybody. A question that was asked is, do I think that tech is going to have their continued rise that we saw with companies like NVIDIA and Microsoft and Meta? Every time I think of Meta, I have to think of it's Facebook first, but then it's Meta. I think that those stocks themselves are probably trading near their high. Not that I think it's a bad time to get into them, but I don't think that you're going to see so much of a run up in the overall, in those stocks in particular, nor do I think you're going to see a massive run up in the tech sector in general. The tech sector had a very bad June. Pretty much all the other sectors in the U.S. economy, those were positive for the month of June, and tech actually had its contraction. So I think that all of the run up that we've seen in the tech sectors, I think that's kind of where we are. I think that you maybe have 2 to 4% increase in the overall sector itself as far as growth, which I think is it is going to be less than the overall market. So there are some individual positions as far as tech that we can get into. You've seen one of the biggest performers in the portfolios has been 2 or 3 of the tech ETFs that we own inside of the portfolio. So we do have exposure to tech. We did take advantage of the nice run up that we've seen in the overall tech markets. But I think if you want to have a further conversation about kind of diving more into the AI technology, that is a conversation that we can have in the office. So, to kind of wrap things up, there are some headwinds in the overall markets out there, but it remains important that we always stick to the plan. It can be difficult to sometimes ignore the headlines and ignore the noise. The markets historically always fluctuate and do recover. Making sure we keep progress towards the long-term goals and not so much focusing on the short-term performance. The performance we've seen out of the portfolio so far this year has been very good, but market swings really can make it difficult to handle the emotional aspect of it. We want to make sure we have proper diversification and do our rebalancing. But if anybody has any questions about this seminar, you want to get about my presentation, you want to get a copy of it, I do record it. We do post it to our YouTube channel. We post a link to it on our Facebook page and all of our social media. If you have any questions, please feel free to email me. It's Ryan, R-Y-A-N, @prostatisfg.com. That's F as in financial, G as in group. Or you can always give me a call in the office, 410-863-1040. I just want to say thank you for everybody for listening, and I hope everybody has a great rest of the evening and a wonderful rest of the week, and I will see everybody in the office shortly. Thank you, and have a good night.